what is good, ladies and gentlemen? We are back. It is January 7th, 2024. It is Sunday. We are approaching the second trading week of 2024. Pretty exciting. We did have a good first week. Not too crazy action as expected, but overall it was a pretty great week. Pretty good way to kick off the new year and the beginning of January. But in this video, I kind of want to explain how I personally use standard deviations within my scalping model. I do want to note this is not needed, right? If you're a little bit more advanced and have a better interpretation of how to spot MMXM models, 100% use this to your advantage, especially if you're trading my scalping model. But I just want to put emphasis on, as long as you're aligned with M1 structure for the 15-second scalping or the M5 for the 30-second scalping, you're going to be completely fine with just that. But if you're wanting to get a little bit more precise and know when we get into some questionable areas where you should engage and not engage with price, that's kind of my ultimate goal here. And I kind of want to just provide a simple and easy explanation of how to spot a MMXM model. In essence, it's basically just identifying the manipulation leg. The easiest way to spot this is basically a lot of times we will have a high time frame. In this case, more than likely it's going to be an M5 or an M1 for us, since we are scalping on low time frames. We will have a buy side level up here in this case, because this is turning into a market maker sell model, and we will take out this little internal high right here. In most cases, I don't really look at it all the time. But we will usually have some SMT either here, i.e. ES didn't take that high and had a failed swing and then displaced down, or it can be over on this other side right here. NQ made a failed swing right here, or ES, or whereas ES would have taken that high. But where this entertains or pertains to my scalping model is identifying the areas where you should engage and not engage. Just like in the video I posted the other day about using M1 fair value gaps kind of as your framework. In a sense, this is going to be the same process. I'm going to give you a couple little scenarios right up here. So in this specific one, right, say we had obviously, or actually, let me hop back into this. Let me rewind a little bit. So with that in mind, how do we draw our standard deviation, right? It's going to be the manipulation leg. So the leg that took out this buy side level, that internal one, and we closed below it. This is where our CISD occurs. This right here, these are going to be up close candles. Once we get a clean closure below those, that's our CISD. That's our change in state of delivery. That's our telltale sign that the market's wanting to turn over and start rolling into a sell program. So from there, what we can identify is we can draw out our standard deviations, and it's quite simple actually. So we're just going to get the high of that leg right there and the low of that leg, and that's it. That's how we draw our standard deviations. From there, all we do is just kind of put some significant areas around there. But getting into the, I'll get down into this in a little bit, but I kind of want to go over some examples of where I would entertain stuff and where I wouldn't in regards to MMXM, because in reality, since we are trading on such a low time frame, you can play both sides of the market. Obviously one's going to have a little bit more probability, just because that's where order flow is. Obviously in this case, taking scalp shorts are going to be the highest probable, but with the right eye, you can take both sides. So kind of getting into this, like in the video I said yesterday, in this scenario, obviously we displaced below this low, but we're starting to get a low time frame retracement back up into this M1 fair value gap up here, right? When we have that, those are going to act as a magnet for price because price was inefficiently delivered. We're wanting to see price come back up into that before continuing down lower in the market maker sell model, so it can efficiently deliver price, i.e. it will give us speed to the downside, if that makes sense. But in this specific scenario, say we get a scalping model set up right down here. Obviously, we want to measure if price has enough room to come up to that M1 fair value gap, right? So obviously you can see right here, it meets the requirement. We have 13.5 points before it reaches up there. But I want to present this other scenario because we're obviously not always going to have just a singular M1 fair value gap. A lot of times we will have two. In most cases, this will be an M5 fair value gap if there are two 1 minute fair value gaps. But something to keep in mind is if there are two, even though we have this one that's in discount or premium, because obviously down here would be discount, it would be flipped if this was a market maker buy model. But I'm expecting this bottom fair value gap to support price. It's not always guaranteed that we're going to come up in here. Even though it's an OTE, I don't care. A lot of times price will leave that as a breakaway because why? Most of the times, this is going to be an M5 fair value gap. If there are two fair value gaps on the 1 minute, it's going to be an M5 fair value gap, a singular M5 fair value gap. So once that gets repriced, price can efficiently deliver back down to the downside. You know what I mean? So in this case, what we can identify is if we get a scalping model set up right there, we don't have enough room to take this against order flow. So obviously you should completely disregard this as you're just digging yourself a grave. But here is where my A plus scalp setup comes in hand, right? So obviously if we have a M1 fair value gap out of there, I'm looking for price to come up back into it, and I'm gonna look for scalp shorts out of it. That's gonna be my A plus setup. That's the setup that has a 90 to 92% win rate, and I'm serious about that. When you are in alignment with the order flow and you're trading out of your higher time frame inefficiencies, this is no different than trading the higher time frame. It's just it's a simplified fractal model of the 2022 model. It's the same framework, just a little bit simpler and easier to spot. So getting into that, obviously, that's my A plus right there. We come up to an M1 fair value gap. Price is in a sell program. I'm looking for it to support price back to the downside, and I'm going to be looking for scalp shorts out of it somewhere around here. And if I really, really wanted, if price was moving clean, I wouldn't mind pulling a little bit more down for my price target instead of taking off at like 12 or 18. Say this was down here at like 25 points. I wouldn't mind pulling down one con down there and pulling one off there because it's a really high likelihood that we're going to go take that low. Same thing right here. Obviously, this is going to be the same thought process. If there's enough room down here to take scalps back into this M1 fair value gap, go ahead. If there's two, it's likely going to be an M5. So expect the bottom one to support price. But this is something I really, really want to note because I feel like a lot of people had questions because a lot of times in my YouTube videos, you'll just see a completely random gray box on the screen. And I don't think people realize what it is, but it's going to be 9 times out of 10, it's my, if it's gray, it's going to be like, this is my -2, -2.5 standard deviation. So I'll draw that out and it kind of gives me a framework if price is going to respect it or if it's going to close through it. In this case, what I would be expecting here is if we had a high time frame sell side level right down here and we took it, bounce out of that -2, -2.5, I'm expecting a retracement taking out some of these buy side levels right up here. But if we get a clean close below it, i.e. like right here, let me draw this out a little bit. I'm using this -2, -2.5 standard deviation kind of as an M1 fair value gap, if that makes sense. And a lot of times there will be an M1 fair value gap that is aligned with here. Why? The -2, -2.5 standard deviation, when it has a clean close below it, a lot of times that's going to support price and send us down to this -4 standard deviation. So just as before with my A plus model, I would personally actually deem this almost an A plus setup because I have two confluences, higher time frame confluences lined up right here that are going to give me the highest probable setup. And I'm looking for scalp shorts out of this. Actually, so that turtle soup one I posted on my Twitter, there were no scalp injuries presented, but that's the exact framework I used for that trade. We had closed below the -2, -2.5 standard deviation. I'm actually going to show it over here in a second. And we got a clean little high put in right by a fair value gap. Settling up there, came down there, perfect entry, took down, closed at some equal lows. I'm telling you, the -2, -2.5 standard deviation is a literal cheat code. As when we get a clean close through it, I want to say 9 times out of 10, but more than likely, it's going to take us down to the -4 standard deviation or near the standard 4 or -4 standard deviation. I'll show it in a live example over there in a second. But I just kind of wanted to explain this. Obviously, this would be vice versa if we were in a market maker buy model, but it's all applicable. And I want to explain, like I said at the beginning of the video, this is not needed, but if you really want to, as you develop as a trader, add this in, get a better understanding of how to spot MMXM models, would very, very highly recommend. But as long as you're in alignment with M1 order flow, that's perfectly fine as well. But that's just something to note. And I do want to go over into that example over here. Let me bump down. Actually, I can just do it over here because I believe it's like right down here. Yeah, right here. So let's go back a little bit because I was moving some stuff around. I was looking at it. There actually was a scalping model set up, but I was already in the trade, right? So right here, let's bump up, or let's go look at our M1. Where is it? M1, right? We had a higher time frame inefficiency that we delivered off of. We took out this internal buy side level right here. So from there, what we can do is mark out our manipulation leg, which is this low to that high. And from there, that gives us our framework for the trade, right? So I had gotten back from the gym and I saw that we had a clean closure below this. And once we put in this little high right over here, this was actually, I believe, yeah. Oh, beautiful. This is such a good example. This is such a good example. M1 fair value gap, like I was just explaining right here, right? Get an M1 fair value gap. Let me put it yellow real quick. Right. So we have an M1 fair value gap there, right? I'm expecting that when it's in alignment with a -2, -2.5 standard deviation to support price and send us to the downside. We get this little, very obvious low time frame buy side right up here. This upper wick, this immediately caught my attention. I was like, all right, perfect. I'm going to set a limit up there. If price wants to come up into there, back into that M1 fair value gap, I am 1000% taking a short there. And actually, in this specific trade, obviously I had a limit set there. The executions are on Twitter, by the way. And I believe I just had it to stop right above that fair value gap. And I was targeting these equal lows. Obviously, you could say, like I was saying, I could target the -4, -4 standard deviation, but I'm not trying to catch a 7.36R move. Obviously, it would be nice, but it's very unlikely. And like I was saying, we are not always going to reach the -4 standard deviation. A lot of times we will get near it. As you can see right here, we were about, let's see how many points we were. 9 points away from it. So we did get close to it, but not quite exactly to it, and that's as expected. So obviously I just wanted to take the low-hanging fruit, which was those obvious equal lows. So that was just an easy target, and that's actually a really good explanation of what I was just explaining on how I use the standard deviations to give me a framework, because a lot of times you could be down here and be like, well, shoot, we're in a steep discount. I mean, I'm looking for a reversal, and I guarantee you a bunch of people got trapped right here, when in reality, we're just repricing a little bit higher before the market wants to deliver a little bit lower before we reversed. You get what I'm saying? So honestly, I just wanted to kind of get this video out there and explain and give kind of an easy explanation of how I use this. Again, this is not needed, but if you want to get really precise, I would highly recommend. It's really cool. It kind of takes the guesswork. It gives you a really good framework of where you should and should not be entertaining certain trades, and kind of just go from there. But with that being said, I do want to note the Discord is finally live. VIP is coming soon. I'm finishing up some legal stuff to make sure everything is good to go before that is launched. But in the meantime, there is a completely whole free section for everybody to chat that is trading by model. And I'm very active in there. So if you have any questions or anything, feel free to join and just shoot me a message either in there on Twitter or comment on the YouTube channel, and I will try to get to it as fast as possible. And I will try to put a link for that down below. I do also want to note Apex is still they're 80% ended, but they are doing a 71% off all evaluations and reoccurring months. So I'll put that down below. But if you don't like Apex because they're intraday trailing, I will also have a MyFunded Forex or MyFunded Futures link down below. They have end of day trailing drawdown, which is really good, especially if you're a newer trader and don't know how to combat the intraday trailing or play with it. So I would highly recommend both of them. They're both good firms. And actually, I do believe MyFunded Futures is doing a 50% off sale on their starter evals. So with that in mind, I will catch y'all in the next video. I'll try and get this uploaded as fast as possible. Like I said, it is Sunday. I want to get this out before the week starts for my little bit more advanced traders and kind of give them some insight of where how I use standard deviations and where I engage and don't engage, especially when we get in some questionable areas. So with that being said, I will catch y'all in the next video. Peace.